You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, it's Jonathan Rose, and for 30 years I've been a professional trader at some of the world's biggest exchanges. Now my mission is to get on every single morning, 11 a.m. Eastern Time, go over the market, share some thoughts. Once in a while, we'll share our trade of the day. I get on here each morning. We get on here about 10 minutes early. We got the chat open saying good morning to everybody. I love the participation in the chat. Thank you for everybody joining. Chuck, Roger, Greg, Ernie, Kendrick, Dale, everybody, thank you for joining. So market's moving a little bit. Are we out of the woods? There's a little strength in the market. Unbelievable. I thought we could only go down, but I guess not. The market could go up, but watch those risk parameters. We look at the VIX. We look at the VIX 9-day. We look at the VVIX. The VVIX is the VIX of the VIX. How much risk is there in the fear index? Well, today, I want to introduce you to another risk measure that we're going to be looking at really closely. It's following municipal bonds, and it's called the MUB. It's something I watch closely. It's something I've watched closely since being on the floor, going back to 1997 at the Chicago Mercantile Exchange. So let's go into the slide deck. I got the questions open. Ask any questions. I will make sure I will get through all the questions. If I don't get through your question right away, I will go back and get through your questions. Screen share. Let's do it. Okay, let me start here. Kate, awesome job. When volatility picks up, a lot of investors get nervous, but that's when traders get excited. As Kate is doing with short-term option trades, yesterday she was able to close out her SPY for 160%, 286%, and then QQQs as well. So really appreciate these short-term trades as a hedge for your overall portfolio in this crazy market. So Kate, really great job. You know what we do when we see really good trades? We celebrate them with a glockenspiel. But Kate, really good job. Kate's done a good job at really learning one trade. Remember, if you're just sitting on stocks, if you're long Microsoft and you're long the big seven and you're just long the world in your IRA, you're actually short volatility. People don't realize that. Your long IRA portfolio, your retirement portfolio, where you're diversified and you're chilling and you're long everything, you are also long risk, long volatility. So when the market picks up like it's doing right now and our risk measures spike, everyone's losing in their long-term portfolio. The reason we want you to trade is because traders can hedge their long-term portfolio with these short-term trades like Kate is doing right now. So Kate, really great job, but that is why we want you trading to hedge your long-term portfolio in this very volatile time. Here's something I found. I'm a big believer, guys. I say it all the time. The creative trader wins. Why do I say that? I just want you to look at the market differently than everybody else in the world, okay? We don't want people staring at the same thing. I found this yesterday. I thought this was very cool. IWM. IWM is an ETF on the Russell 2000. Small caps. Small caps have been getting their butt whooped. But I'm looking at this in a monthly chart. These are all monthly bands, monthly bands, monthly bands. And I'm taking you back to 2000. 2000 up until now. We are looking at small caps. Small caps, when volatility spikes like it's doing right now, get to be the most volatile, the most risky. Small caps go bankrupt before large caps. That's how it works. But looky here. 100 period moving average. 200 period moving average. Now, why do they stop right here? Guys, little test. Why do the moving averages stop? Test. This is a monthly chart. going back to 2000. Why did the moving averages start in 2016, 2017? Anybody got an answer in the chat? I'm going to put on some Jeopardy music. Nobody? Come on. Attaboy. Adam, exactly. It's 200 months, guys. These are months. There's just not enough data. Exactly. Thank you for participating in my little game. But what I want you to notice is the 100 period moving average. We touched it there. The 200, we touched it there. Stocks, indices, they don't like to stay around big numbers. Why? There's a lot of reasons why. Maybe there's lots of buying. Who knows? But it is what it is. Indices don't stay around big numbers. Monthly. Look at this. IWM. Drop down. It's the only big indice that dropped down to its 100 period on a monthly. 177.45. I thought that was very, very cool. And this is a way of stepping back and looking at the bigger picture. So watch that number 177 on your IWM. Let's look at a live chart right now just to see where she's at. But I thought this was very cool. And again, this is being creative. This is working throughout the day and looking, where are we going? IWM, just take it off percentage here. So here's what IWM looks like on a daily. Let's move it over to a weekly. That's what she looks like on a weekly. Maybe getting down to some good support here. But monthly. Look at that monthly. So keep going back. Look for a place for it to fall to. 177 is a gargantuan line in the sand. I think that will give you some really good feel for whether the IWM can rally or can it not. Can it get away from this number? I thought this was very cool. Let's move on to the next slide. Okay, I dropped this in our Discord yesterday. I'm going to pull this up here. So if you watched yesterday's presentation, I showed you this chart. Now this chart is the relationship between the 2-year fixed 2-year notes and 30-year bonds. We're looking at the yield curve. Okay? So let's say the 2-year is at 4% and the 30-year is at 5%. Okay? If the 2-year is at 5% and the 30-year is at 5%, that is a dead flat yield curve. Right now, the yield curve is getting steeper. The 2-year and the 30-year are getting further and further apart. That's probably because the 30-year price is going down so much. Well, ever since Liberation Day, April 2nd, the yield curve has gone parabolic, really. And so all of a sudden, and I'll look at this all the time, you see the yield curve not really doing very much, moving, trying to figure out what's going on. And then all of a sudden, on a day the president calls Liberation Day, you have a gnarly spike. And the market got destroyed. Sold off, rallied, got steep again. Market got annihilated. So yesterday, I shared this in our Discord. I said, guys, no pause. If we get no pause, the market is going to continue to be heavy. Well, look what we have today. Today, hopefully you guys can see this. Can you guys see the screen okay? And does this make sense? What we're looking for is Liberation Day caused this move. Is the move getting tired? Today, finally getting tired. We tried to rally here, but then it rallied back up. So this is something that we can watch. Okay? I got one more thing that we can watch. And it's going to make things a lot easier than trying to watch the yield curve. Next screen. The MUB. That's right. I want to introduce you guys to the MUB, Municipal Bonds ETF, a gargantuan ETF. Right now, I took you back to 2008. 2008 was my best year as a trader. I was lucky enough to clear over $4 million in take home. 2008, the market was going absolutely bananas. This is when the municipal bonds got absolutely crushed. And once that happened, there was no doubt that the market was going to get killed. Because right now, what's going on? It's a tariff issue. It's not a credit issue. It's not a banking issue. But you know what? If we break 102.50 in the MUB, this is going to turn into not just a tariff issue. This is going to turn into a credit issue going back to 08, 09. Personally, guys, I don't think that's going to happen because I think this is a news-based bear market. So what I want you to do is I want all of us, and I'm going to say me included, I want to check on the MUB, excuse me. And every single day, guys, I think that just like we check on the VIX, we need to start watching the MUB. And the reason we're watching the MUB is if this turns into credit risk, we are in a lot of trouble. We want this to stay as tariffs and not as credit. So I'm just going to put on a MUB chart so you can see what I'm looking at. And I think all of you guys should do this in whatever platform that you're using. So MUB, I'm going to take as much data as they'll give me. I'm going to look at it on a weekly. And let's see what we got. I'm going to take off these moving averages because I don't need them. And this is what I will be following. And I think you should be following as well. Because right now, as much as vol's coming out of this market today, the MUB is down. The MUB is down small. But look at this. This is what we were following back in 2008, and this is what happened. This is what caused all the credit issues. So again, right now, and hopefully this makes sense, this is the biggest takeaway for you. Right now, we are having tariff issues, tariff-based news, tariff-based bear market. Watch municipal bonds. If this breaks down here and gets under 102, not only is this a tariff issue, this has become a credit issue as well. And therefore, we're going to see this happen, and then vol's going to spike again, and the market will get absolutely destroyed. So here we go. I got some more slides for you. Risk on. Everyone watches the VIX. MUB is a creative trader's way to read the bond market stress level. Right now, that MUB is sitting at 102.50. And look, we've been here before, guys. We've been here before. What we don't want is this, because that brings credit. I like that, Dale. I like that a lot. Set an alert for that MUB to drop below 102. Also, guys, I got some more slides, but it's also a reason why I'm calling bullshit on today's move. Okay? The thing I like about today's move is if you look, the VVIX, the VIX of the VIX, trading 114. So risk is coming out of the market. That's good. Hey, while I'm getting these charts together, guys, do me a favor. Make sure you hit subscribe. Make sure you give it a thumbs up. It helps more than you realize. And also, while I'm doing this, we also have our member-only chat community. And my managing editor, Chris Water, is in the chat. He'll drop a phone number in the chat. You guys can call, ask any questions, learn about the programs. So VVIX. VVIX we've been watching, right? VVIX spiked. This is the VIX of the VIX. It's getting crushed. We want to see that. Great. What we also want to see is we want these VIXs, VIXI, to come down. VIX 90 at 32 is still high risk. We have the VVIX coming down. The other thing that we need to come down, though, or rally, is this MUB. Risk on trades could start to heat up. If MUB holds the line, institutional bond buyers will likely be stepping in. Volatility may top out and start quickly coming out of the market. I think if MUB rallies, if MUB gets over 104, I am uber bullish. I'm going to come up dressed like a bull, maybe. I don't think I'm really going to do that. I think I'd rather dress like a bear, but I don't want to dress up, guys. Bad idea. Let's get away from that. Could see the QQQ will rally if MUB holds this line. That's what I got for you. Really interesting time in the market. It is kind of like a pivot point right now. And those pivot points present the best trade opportunity because that's when the market can really move. Remember, markets don't like to stay around big numbers. So if you're interested in learning more, we have our member-only community where we share trades in there. But we get on here live every day to talk with everybody. Thanks so much, Chris. I appreciate you dropping the number, 1-800-304-5601. Give us a call. Everybody in All Access, I got a trade for you guys. I got a divergence trade for you. We talked about it in the Discord. I'm going to walk you through that divergence trade right now. Thank you all for coming. Ooh, a question. Roger, a quick explanation of how the price of the MUB reflects risk. Whoops. Yeah, it's credit risk. I mean, it's literally just credit risk. These par for the bonds is 100. So at 100, municipal bonds pay what, 5.5% or 5% tax free. If they're getting under par, the bonds are actually losing value. So they still will get the dividend, but they're going to lose principal on holding the actual bonds. Roger, it gets a little bit advanced, but the par expiration, the expiration of these bonds is 100. So if they return 5% sitting at 100, think about them returning 5%, but you buy it for 100 and you sell it at 90, you're losing on the bonds. Does that make sense? This is widely followed. This is an institutional product. So we'll be talking about this more and more. Roger, great question. But this is, yeah, for sure. But this is definitely something that I'm going to start talking about more and more. I talk about the VIX 9D with you guys. I talk about the VVIX. But when the markets pick up like that, we need more measures because we need to protect ourselves. Awesome. Thanks so much for watching and hanging out with me, guys. All Access, you guys chill. We'll be right back.